Welcome to the David Spisak Show. I am so thankful that you're here. I'm happy to have you joining us. And as always, it is my goal, my intention, as is the intention of every guest that jumps on here, is to provide value, a lot of value for your time. This particular episode is going to be no different. In fact, I'm going to make a very bold statement, a bold wager that this one is in all likelihood going to over-index big time, because I'm fortunate enough to be joined once again by Alan Haig. I love to get Alan on at least once a year because he has such deep insight, because Haig Partners is considered the preeminent sell-side advisory firm out there in retail automotive. And so him and his team literally are knee-deep with dealers all during the year. And so they have a tremendous amount of perspective and insight, not only on where we've been, but I believe on where we're heading. So without further ado, I want to, if you haven't met Alan before, here is Alan Haig. And Alan, I want to thank you for taking the time to come back on.
Well, it's my pleasure, and it's always fun to know somebody has their own show, David. So I compliment you in return for developing your media presence. And I think that, not to reciprocate too much, but the amount of data and knowledge that you have at your fingertips and have developed over the years is also a great resource to the industry in terms of dealers trying to figure out, how can I do better? Am I having the right pay plans? Am I having the right amount of advertising, inventory? Is my cost structure appropriate? And for those of you who haven't been using David's products and services, you should.
You're very kind to say so. This is my 45th year in this business, over 40 years in being knee-deep in data, studying operational profitability, which you know is a passion of mine, as is this industry. We share that. And I would love to start with just what you just mentioned. You know, all of those things that comprise all the aspects of the dealership, which not only end up creating the outcome in any given month or year for a store, but it also has a direct relationship, as you know, to the value of a store. And I find it interesting always that for most of the dealers that I've known over the years, there's two things that seem to be true. Number one, the biggest equity they have, the biggest asset is indeed their dealership organization. Two, it's unlike any stocks that they may own in the market. It's the hardest one sometimes for dealers to keep track of, right? They can open up the stock app on their Apple iPhone or check Yahoo Finance or Wall Street Journal, and they could see how their portfolio is doing, but not as easy to do with respect to their dealership. So I want to start with this. What did you see in 2024 collectively as an industry? How did we do? I know we went down roughly about 25% from 23 versus 22. How do you think we're going to turn out from 24 to 23?
Well, the industry's been on a ride, and I smile because I'm one of those guys that used to like to predict things. And I think I learned in COVID, you can't predict nothing. Right? It's just stunning to think that this global catastrophe could end up certainly causing a lot of loss in lives, but also enriching almost everybody involved in the automotive industry. So we went from pretty good times before the pandemic hit. We were kind of slowly having margin compression and rising expenses, and that was causing even the best of dealers to kind of go sideways in terms of their earnings, to tripling. The average dealership tripled in profit if you look at the data that comes from the public companies, which to me is the cleanest data out there because the statements are accurate. You know, almost every private dealership statement we see has a lot of adjustments that you need to make to see what really is the cash flow coming out of that business. So we went to a peak where we more than tripled in profits. 2024 has probably kind of come down to about double the profits that we had before the pandemic. So if the average public company was making $2 million in profits in 2017, 18, 19, it's going to make roughly $4 million in 2024. Now, there's become a much better or greater variation in terms of the franchise performance. During the pandemic, every brand did great. Nissan stores made a lot of money. Kia stores made a lot of money. Ford stores, Mercedes, Toyota, Honda, everybody that could
Even
sell a car.
Stellantis stores made money.
Stellantis stores made a lot of money. Things have changed, right? Starting about 36 months ago for Stellantis, when they started raising their prices so much, those sales have been coming down and profits have been coming down. And so some brands are challenged today, like Stellantis, like Nissan, like Infiniti, and some other brands. And then the mass majority of the brands, their earnings are down maybe a third. The new car grosses have fallen significantly, maybe even half. And David, this is one area that I know that you get a lot of data every month from some of the dealerships that are reporting into your products. So we saw a normalization, if you will, on the front end gross profit. I spoke with the Ford dealer yesterday and he goes, what the heck? We're right back where we were. We're giving the trucks away. We're just making the dealer fee and F&I. How could this have happened? But we also talked to Hyundai and Kia dealers that are doing quite well on the front end, far more than they were making before the pandemic. And we talked to Honda and Toyota dealers that in some cases are putting addendums on their cars still. They're still getting, when you include the other vehicle income and the dealer fees, $3,000-$5,000 front end gross, plus another $1,500, $2,000 in F&I. And the luxury dealers are still doing really well outside of their EV products. So in general, we're not making as much as we were during the pandemic, but we're making way more in general than we were before the pandemic hit. So I think most dealers are still pretty happy. And that continues to show up in the buy-sell market. Dave, we still see a lot of activity, and the prices are still, in my opinion, quite strong, a good bit higher than they were before the pandemic hit. And we don't really see that dialing back now, particularly after the results of the presidential election, that I think for many dealers gives them more confidence to invest. It's certainly a controversial election and everybody has their opinions and their choices. But so far, the reaction of dealership buyers has been positive to the news.
Yeah, I think there's a couple of things I'd love to do as a result of your comments there. First and foremost, your comment about how everybody did great, and now it really depends on the franchise and the brand. I see it the exact same way. I suspect we're going to end up when it all clears, when all the dust clears, that we'll be down 30 to 35%, 24 versus 23 maybe. The comment with regards to the public companies is important because it's not just the accuracy, but it's consistency, right? Privates not only have their own way of doing things, but it may shift from year to year. So it's even harder in some of the privates I work with, where I have some groups where they may not share the same chart of accounts consistently, or they may shift the way they look at things from year to year. And so the publics, you can count on that consistency year over year. And so you can have a great degree of confidence when you look at the year over year numbers that they're pretty true. The flip side of things is the publics I won't say they do everything right, but relatively speaking, they do everything right? They manage their cash much better than they over-index there. They over-index on managing expenses. They over-index on their management of their assets. And they tend to be far more process-driven. So when you get into the privates, I typically see very different numbers on the private sides than I do on the public side. And on the private side, the second part of that is not just the franchises, but such a level of, or such a wide degree, a bandwidth of performance. So I was just looking at 3 different GM groups today, or groups at GM stores. And, in one of them, they're outperforming their market, their region, the country. The second one is about a half. The other one is making no money, right? And it's just like, well, it's the same brand, same franchise, same website, same model, same incentives. So would you say that not only to a much greater degree the franchise matters, but also the leadership processes and performance matters a lot more? Would you say that's true?
Well, there are lots of differences between the public companies and private companies. And Dave, you and I both worked together at AutoNation for a number of years, so we've seen what that business looks like in-house, and then we serve mostly private dealers today. And I see pretty big variations. I think in general, the public companies do a better job with F&I. They're much more process oriented. And they have to be very clean with their processes, or they get sued by the state's attorney generals,
Yeah.
in a big way.
And they're a big target if they're on the wrong side.
Yeah. I typically see, in my opinion, the private dealers are, I think, often more responsive on the new vehicle sales side. They're able to respond to trends better. Maybe they can work their suppliers a little bit better. I think that, we often see the superstars in our industry. If you look at the top selling dealerships of almost any franchise, they're almost always owned by an individual, not a publicly traded company. So I attribute that to sometimes the very best talent can make more in a privately owned store than in a publicly owned store, because public retailers believe, hey, we've given you all these services and support systems and national brands and everything else to help you be successful in your business. So we don't have to pay you, full price too. We can't do both.
Right.
And so, I see the public companies do a great job on fixed operations, I believe, and an F&I. I believe often the privates do maybe a better job on selling new cars and sometimes getting higher grosses, because if we know public companies have a hard time selling over sticker, it's hard for them to do that and again, not get sued by people or just presenting themselves in what they think might be an unethical way,
optics,
or a way that upsets the factories. An entrepreneur is a little less bound by some of those concerns. And if they think, hey, if the market is $5,000 over for my Sequoia a Diamond Edition, I can't remember what it's called, why would I sell it for a penny less? And I understand the logic of those dealers that have that rationale, because it's not fun for them to sell a vehicle to a customer and then see the vehicle show up, the next day that they flipped it and they make the $5,000.
Yeah. Don't you think, Alan?
They're a little bit different animals, if you will.
Don't you think on the private side there still is some real cachet, there's some real value in their ability to connect to their local communities?
Yes, absolutely. We represented a couple that owned 2 Stellantis dealerships in the Charlotte, North Carolina area, and we closed on that transaction 2 years ago, so it's a little while ago. But I couldn't have been more impressed with the way that they integrated themselves into the local community. This is Jack Saltzman and Robin Saltzman. And they used to own that store with a very large consolidator who really wanted to do all the marketing digitally, which is the convention, right? You've got to do digital marketing, Google search, all that kind of stuff. That's the way to promote your business. And Robin Saltzman said, no, I want to promote my business locally. So every PTA organization, she was there supporting it. Every animal shelter, she was there supporting it. Every women's shelter, she was there supporting it. And they gave up space in their dealerships for meetings. They gave donations constantly. And they created such a strong local following that they really outperformed their peers. And I think it was a lot because of their local community input. Now, they can do that pretty easily because they own the store and they can decide, whom to give money to. If you're an AutoNation or a Lithia, perhaps, how can you have those types of attention at the local levels? It's really difficult. So AutoNation, for instance, will choose their charity
breast cancer.
Yeah, breast cancer. So they're giving millions of dollars to breast cancer research, which matters to customers. But it's also, that money's going to some national center somewhere else. It's not going to my kids'
That's right.
PTA, which is going to help buy, school supplies for teachers that need to provide it to their students. So this is an advantage of being in the local community and understanding. And it's not just what the communities, it's often what their employees support. It's a way to give back to what their employees care about, because people want to make a paycheck. But I think they also like to work for organizations that make a positive difference in their local community. And that's something that I think that private dealers can do more easily than a large public company. And that matters.
Alan, when you look back on 2024, which it sounded like it was a very successful year, another very successful year for Haig, to say the least, right? And I believe, if I'm not mistaken, when I was on your website fairly recently, was it 10 years?
Yes.
Congratulations.
We celebrated 10 years of being a business, and it feels like 2 months.
Isn't it crazy?
How fast it went. I'm reminded of that phrase that, life is like a roll of toilet paper. It goes faster towards the end.
Yeah.
hopefully we have a lot left to go, Dave. But yeah, it's been a really terrific experience for my team and for me to have been able to represent so many talented entrepreneurs. And we also represent, some of the largest dealership groups in the country that have decided to divest certain dealerships. So whether it's, the Penske's or the Group Ones or the AutoNations or
Lithia,
the Ullmans or the Lithias or the, well, we actually haven't represented Lithia on the sell side, but the Hendrick folks, that's a joy for us to be able to work with those people because they really are the leaders in our industry in many ways. But last year was a lot of fun for us. We represented, 4 or 5 platforms that had 8 or more dealerships. So it's fun to work on those transactions that can surpass $1 billion in value. But we also had the pleasure of working with people that had single stores, and that asset, as you mentioned, is the most valuable asset that they own or may ever own. So, we like working with large firms. Often that means larger fees for us, and we're certainly capitalists and we care about that. But it's really one of the great joys about our business is that we get to serve entrepreneurs as well, because they're people. They've got families, they've got employees they care a lot about. Their name is on the store, logo. It's not just selling a stock or a bond for them. It's selling their life's work, and we really bust our tails to try to maximize the value for them when we sell. And certainly we were helped by the strength of the market. It wasn't just that Haig Partners got a lot better in 2024 than previous years. There were a lot of transactions, and most of those transactions were at quite high values per store, if you will. So it's been a perfect storm for us. And now for us to maintain that level of revenue and profitability, we've got to work harder and smarter. And that's what our future is focused on.
So in previous years, you mentioned this, you had, and I can recall, I have thankfully a pretty good memory still at the ripe old age of 65. By the way, I'm a pretty transparent person. January 2nd, I became officially a member of an incredible group called Medicare. And so I turned 65 in November, and you find out shortly after that you need to join Medicare. No, you have to join Medicare. No, I'm fine. I'm already covered. I go, no, you must join Medicare or we will penalize you. So I'm on Medicare. But, as you look back on 2024, which was another remarkable year, it sounds like for you, one of the things that it makes me think of is I think about in years past that you've often been associated not just with incredible legacy organizations, you mentioned some of them, Hendrick or Morgan or others, but that you've had the pleasure of not just reporting that you maximized somebody's life work, but you did it to the point where it was record breaking. And you've done that for a number of years. I'm curious, in 2024, were there any transactions that Haig Partner was involved with that was that you were able to say on top of everything else, the icing on the cake was it was a record?
There were a few transactions. We represented the owners of South Motors and Vista Motors, which is a South Florida-based organization. And we were really pleased to represent them. And in that process, according to the factories, we were told that we established a record franchise value for BMW dealerships and for Honda dealerships. Later in 2024, we represented the owners of Hollywood Kia and helped establish the high water mark for that franchise as well. And then the previous year, we had the pleasure of representing Al Hendrickson Jr. in the sale of his Toyota store in South Florida. And at the time we sold that business, that was the most value paid for any franchise, any dealership, period. Now, our feelings were a little bit hurt because shortly after that, there were 2 Mercedes stores that sold in Miami and one of them eclipsed that value. So we have to tip our hat to Mercedes, at least on that one. But that was certainly fun for us, and I think it was certainly pleasurable for our clients to receive value. But those businesses were that valuable for good reasons. They produced an enormous amount of profit for the owners, and so it made sense for the buyers of those businesses to really step up and buy them, and they competed for them. There were a number of buyers for all those stores that really wanted them, and so they had to reach out. Also in 2023, I think it was, we set the record for Stellantis. So
that's right.
It's been fun, during this period. I don't know that we'll set records again in the near future. The values are dropping as the profits are dropping, but certainly we won't forget 2024. We had the pleasure of being involved in advising the owners of 58 stores that we advised them on the sale of. And it was fun for us, every one of those. And certainly if you do that volume of transactions, and we're not necessarily focused on volume, really focused on delivering the best value per client, but it helps to deliver value per client if you have enough transaction value or volume. You understand what a store is worth. You understand who the best buyers are for these assets. You understand how to present the assets well and help your clients to negotiate. So, volume helps to drive value. And that's something that we're focused on in 2025 as well, to make sure that we're involved in enough transactions so that we can accurately tell an owner of a store before they go to market what they can expect someone to offer for their business. So if they want a lot more than where the market is, they should probably wait, call you, Dave, get those profits up, and then go back to market.
It's funny where I'm seeing that more and more, to where dealers are starting to recognize, and it makes it makes all the sense in the world, depending on the franchise, whether you're a multiple of a 2 or 4, 6, 8, 10, whatever it might be. But, when I can go in and help a dealership improve their profitability by $1 million, if the multiple is 6, that's a $6 million upside for that $1 million. Not terrible.
Yes.
So it makes a lot of sense. I brought it up primarily just because I was curious. I wanted to know. I'm sitting here thinking, in a down year, we were down 25% in 2 years ago. Last year, probably 30, 35%. So if we're down 60% collectively in profit industry-wide over the last 2 years, but we're still seeing record-breaking sales, I think it's tremendously uplifting. And I think it yet again says how resilient and how viable this industry continues to be. You mentioned the new administration coming in, regardless of who you voted for, if you didn't vote for anybody, but regardless of what side you land there, as you said, I think in this industry, not just for people that own, but people that are, involved around the industry, and even people buying, I think there, in general, is a tremendous amount of optimism as it pertains to the economy, and that's good for everybody. And so, I will be honestly surprised, because on one hand, I expect net profits to go down again, but of course, some of that is really being pulled down by specific franchises. But I would be surprised if we didn't see at least another, if you weren't reporting a year from now, and potentially another record-breaking deal, because this business just has a tremendous amount of viability, and I think that the future, despite that we have so much going on, you've got conversations, Alan, with Nissan and Honda. Hey, we may be, it's starting to sound like, what's that show, Survivor? We need to start a strategic alliances. And we have obviously the continued disruption that we're going to see, and we don't know what's going to happen in the next stage of EVs. We know they're not going to go away. And we have a whole lot of things that there's some uncertainty. But I think that most people in this industry have a tremendous level of confidence overall and true optimism going into this year, despite the fact they're well aware of the fact that we're likely to continue to see margin compression on new cars. We're likely to see a trough in used cars, inventory availability. But There's always a way, if you're a good operator, to make good things happen, don't you think?
I do. I think that this change in performance and new vehicle sales, and we've seen a big change. The Nissan, the Stellantis stores, they're down a lot. 40% or so in their front sales, new car sales. So we are seeing even talented dealers saying, like, I'm out on this franchise. I've owned this franchise for a year or 20 years, but it's not working for me anymore. And so we're seeing, really good dealership groups, including the public companies. I think AutoNation divested 8 dealerships in the third quarter of last year, say to themselves, hey, if I've got an asset that's not really performing and I don't think I can fix it soon, it's not right for me to hold this business. I'm going to sell it. And we're seeing a reshuffling of the deck, where during the pandemic, people had so much cash, they wanted to grow. They would buy a dealership out of their market, a franchise they didn't know that well. Some of those acquisitions maybe weren't working out as well as they'd liked. Or, a manager left them, they couldn't backfill them with somebody of equal ability. So we are seeing a shift from setting records for some of these franchises, because as the profits decline, it's hard to do that unless you have a franchise like a Mazda. There's a future high watermark for Mazda. I think that's
agree.
A brand.
I think Mazda is such a sleeper.
Yeah, we had great success selling a JLR store earlier this year, but I think that's another franchise that's probably going to set a record in maybe 2025. But we're also going to see a lot of dealerships that are broken, and the dealers are going to say, I'm out. So we won't be setting records when we sell a Stellantis store or a Nissan store. But for that seller, and I learned this when I was at AutoNation years ago, and I was there twice in my career, Dave. The second time we were working together, and from 04 to 08, I bought 14 stores for them, and I sold 56. And of those 56 that we sold, they were broken stores. And some of the ones were when we bought when I first joined in 96 and 97. And a divestiture does some really good things for the divesting company. It generates a lot of cash from the sale of the real estate, from the liquidation of the inventories, contracts in transit. A lot of cash comes back to them. It eliminates a loss, and these dealerships can go backwards. Dave, I don't know what the percentage of stores are today that are losing money on the statement, but I would bet it's north of 15% at this point. And it eliminates a headache where the owner has been sending good people, and sometimes they go there and they die.
Yeah.
A good person gets into a weak store and they become a weak person and they quit or they leave the organization. So a bad store can really chew up good people. And instead, we're selling those dealerships to newer dealers, younger dealers, hungrier dealers. If you've got 10 stores, you got Toyota, Honda, BMW, Chrysler, or not Chrysler, Kia, Ford, and you got a tough Stellantis store. You could be a great dealer, but be spending 10, 20% of your time on your weakest asset.
That's the problem.
Yeah. If you carve off that asset, you get cash back in that you can use just to put in the bank or invest in a better business, and you get rid of this headache. And we've seen it where headaches start to create, it's almost like, Dave, that used car that is hard to sell because for whatever reason, customers don't like it.
Yeah.
Salespeople start to walk around it, right? And it ages and it gets even worse. And the same thing happens if a group has a portfolio of dealerships. If there's a problem store, it chews up talent, or nobody wants to go work there. It just gets worse and worse and it deteriorates. So we're seeing an increasing number of divestitures happen in our industry as some of these brands have just fallen off to the point where they're losing money for the owners. And what's the point of owning a money-losing asset if you're not confident you can turn it around?
Well, isn't it a little bit offensive to call it an asset when it loses money?
But it still has value.
No.
Even stores are losing money. We were selling a Stellantis store in the fall, and we got $9 million offer for it, losing $2 million a year. It's in a good market, and people thought, I could fix that. I've got a team of people that can correct it.
Alan, it's interesting. Those 56 stores you divested of, which did not work for AutoNation, many of them ended up working for somebody else. Many of them ended up becoming maybe not a great store, but a viable store. And some of those, because they became viable stores, allowed that particular dealer to get approved for another franchise and a better franchise. I love this industry. There's nothing like it.
It's really it's almost like recycling or
Regenerative,
yeah,
right?
regenerative. And I'll tell you this the story. I'll tell you a story about there's a dealership I bought in 1996 called Taylor Chrysler Jeep, Taylor, Michigan, and they had a used car superstore concept, and that's what AutoNation was all about at that time. So I flew up there and bought the store. I knew I was overpaying for the store, but that's what my boss wanted me to do to lock out another competitor. And then, years later, it's losing money. I go up there to sell it, and I meet the buyer, the day before closing, and I asked him, "What are you going to do differently than we have been doing?" Because I was making me feel a little ill. We'd buy these stores, own them, break them, and then sell them. And he said, "Well, the first thing I'm going to do is I'm going to replace all the burned out light bulbs that you have in the parking lot. And then the next thing I'm doing is I'm replacing the burned out light bulbs you have in the sign, Taylor Chrysler Jeep, tearing out the stained carpet you have when the customers walk in. I'm repairing the bathrooms. I'm putting ads in the paper. I'm bringing in 10 trucks of new and used inventory. And I've got this GM over here that I'm going to put in there who's got 20% of the store." And I looked over and I saw that GM, the partner. He had such a carnivorous look in his eye. He knew he was going to kill it. And he did. And so AutoNation got out of an asset that they really didn't belong owning. They had no other stores in Michigan. They couldn't access the best talent. They couldn't really give it the care that it needed. It sold to a neighboring dealer that could do all of those things, knew the customers, knew the market, knew how to price the product, knew what product to have on the lot, knew what managers to bring in to serve those customers and to manage those people. It was a win-win-win. Better for AutoNation, better for the buyer.
That's my point.
Better for Chrysler.
It's crazy. It's the proverbial one man heaven, another person's hell, right? Or invert that the other way around. Alan, one last question about 2024. I think people are always interested in. Will you consider, who is buying in 2024 overwhelmingly private?
90% of the stores that sold last year were acquired by private dealers or dealership groups.
Do you suspect that's going to change this year? I mean, Lithia and other companies still have stated that they have an appetite for growth, year-over-year growth, and some of that same-store sales, a lot of it is acquiring additional stores.
Yes, I think that the publics will probably take more share in 2025. They were, in some cases, buying back stock in 2024 and also integrating some of the big transactions that they had done in previous years. And, when you buy 10, 20, 30 stores, even for a large organization, there's a significant amount of integration work that needs to be done, pay plans and marketing and systems and training and everything else. So
culture.
There was a lot of growth during the pandemic time. Lithia bought a ton of stores. Group One was active. Almost all the publics were active. So I think that they are ready to come back to the market. I think they were probably also hoping for dealership prices to fall some, where they felt like they could get a higher return on investment. Because if you're a public company and you have all this cash coming out of all the dealerships you own that are making lots of money, they have multiple uses for that cash. They can buy dealerships, they can buy back their stock, they can issue dividends. They just give cash back to the shareholders.
Or paying down expenses.
Yeah, and they can invest in their dealerships for expansion, et cetera, CapEx. If you're a private dealer, you kind of have, well, I can put the money in the bank or I can buy stores. They're not going to go buy back their own stock, right? Because they already own stock. So I think that a lot of the private dealers were saying like, that's when interest rates were low. There's no point in leaving the money in the bank. I'm better off going to buy a store, even if it's more money than what I want to spend, because I don't have a better place to put it. Auto dealerships still provide a higher return on invested capital than almost any other asset class that I know of. So I think that the private dealers, they kept their foot on the accelerator doing acquisitions in 2024 as well as previous years. We still see that now. I mean, I would say that, we did a transaction last year with Lithia. I think it was the only public company that we dealt with last year in terms of a closing. And of the transactions we're working on right now, none of them have been signed up by the publics. They're all private groups that are buying the businesses that we're representing. And I expect that to change. I know we have some really good opportunities coming that I'll be calling some of our friends that I think would be logical buyers that are publicly traded companies. And I think they'll be more responsive in 2025 and hungrier than they were in 2024.
And then going forward, I mean, you would have to think by the end of the year, this is the third year in a row that we're going to see declining net profits unless, we are, we end up finding ourselves with another 100-year pandemic, which at that point, it'll be a 2-year pandemic. But another pandemic or chip shortage, that's not likely to happen. So we're much more likely to see a third year of decline, considering the fact that stores, their ability to sell their stores and the valuation, somewhat at least, are oftentimes based on 3-year priors. And the business is not typically on the new car side likely to get easier. You're probably not going to have OEMs that are going to ease up in terms of their demands or expectations for facilities. You continue to have dealers that are aging, right? And as you know better than anybody, the average dealer is probably contemplating this after 65, 70, something in that nature. The combination of those facts would lead me to think that we may see more activity this year, but I have a sense that you've got some caution there. In other words, that you're not so sure that we may see the same. It may be down a little bit. Can you speak to what your thoughts are as we go into 2025? If you're a dealer that's thinking about selling, thinking about buying, thinking about selling, if you're thinking about buying, you're thinking this may be a really good opportunity year, and it may well be. If you're thinking about selling, you're thinking this might be the year I need to get really serious and decide whether I'm going to stay in for the long term or whether I'm going to need to make a decision if this is the right time to maximize my life's work. What would you say to that? What is 2025 as an outlook on the buy-sell side? What does that look like to you?
I think that 2025 is going to bring more certainty about the earnings of the stores that people may be looking at selling or buying. We had such a spike in profits, and then people were always expecting that would come down. No one knows how far they're going to decline, right? In my opinion, they're going to land probably 50%, at least 50% higher than where they were. If nothing else, just inflation. And we can walk through my math if you want in a moment. But there were a number of transactions that didn't happen because the seller was like, hey, that's a low multiple of my historical earnings. And the buyer was like, that's because you're not going to make those earnings in the future. You're going to be making a lot less. And the seller was like, well, I don't agree. So then the deal wouldn't happen. Now that the stores have come down to where kind of they are, it's easier for buyers and sellers, I think, to agree on, are the current profits going to be similar to, the future profits going to be similar to the current profits? If so, it's easier for people to agree on value. So I think now that we're coming into a more of a level area of dealership performance in terms of monthly profits, it's not going to be, you're not going to have a bid-ask spread of 20% or 30% or more in some cases between the buyer and the seller. So that means that whatever comes to market, so long as the sellers are properly informed about what values they can expect, they should happen more easily. So I'm optimistic that will allow more people who come to market. There'll be a higher percentage of those transactions that will close on terms that the seller's happy with.
If we were to go backwards year over year, what would cause that pressure? What would cause it to, in your mind, to be a less robust or a lower volume transaction market this year than last year?
Well, I think that, when dealership values are really high, if you own a dealership, you think, well, why would I wait for another 3 to 5 years of continuing to operate this business if I can get all that value now? So I think that the increase in dealership values hold ahead some sellers. It's kind of like you own a stock. Like when stock's really high, that's when you should probably sell it.
Yeah.
You don't know. Maybe it'll go higher, but maybe it'll go lower. And so I think for a lot of families, they decided, hey, this is more money than we ever thought we'd have from between the extra earnings and the extra value of the stores. Let's take the money while it's good. Because there's still risks in our business, right, David? We don't know what's going to happen with Tesla autonomous vehicles. We don't know what's going to happen with other consumer. We don't know what's going to happen with interest rates or wars around the country, around the world. But for many families, they said, hey, let's take this money now. It's so much more than we thought we would get. Let's get out. So that pulled ahead some of the demand. Now, we're still seeing higher transaction volume today. I think there'll be roughly 500 stores that sell in 2024. The peak was over 700. That was in 2021. But before the pandemic, we were in the 300s.
Yeah.
So we're still seeing a lot more M&A volume. And I think that in 2025, we'll end up somewhere between 400 and 500 is my current estimate, based upon what we see in our pipeline compared to last year.
Do you have a sense, or have you seen in the last 10 years any changes with respect to succession and the role that plays in what we see in the buy-sell market? In other words, when there's not a succession plan, somebody's had a dealership for a long time, of course, they're typically going to sell that store. When they have clarity on a succession plan, they're probably going to keep the store. And if there's it's a little bit nebulous, it could go either way. Has succession's impact on our industry, on dealership buy-sells, have you seen any change, any shift over the last 5 to 10 years?
I think so, Dave. And I think part of it's because the values have gone up so much. It's a little harder for the son to buy out the dad, or the GM to buy out the owner.
It is true.
Or the daughter to buy out the dad. We have plenty of female dealers too. I don't mean any slight. It's really just how do they finance these acquisitions? And that's led to a new form of capital, which I think is helpful, where a private equity firm or a family office will say to a dealership group, well, let me buy 40% of your company. You can take that cash and give it to the kids that are not in the business, or give it to the dad, the seller. And then, the kids that want to continue in the business and are in the business today, they can keep their positions. And now they've got, a deep pockets investor that they can go out and buy stores with. And there are plenty of people, as you get older, you naturally get more conservative with your cash, with your investments. Plenty of groups that kind of stopped growing 10 or 20 years ago.
Yeah.
And the kids are like, hey, Dad, why don't we buy some more stores? Well, I don't know if this is the right time. Dealership values are high. I may be getting out. If I buy more, it's going to be harder to get out. That's true. So if I get bigger, it's even harder to exit.
That's a great question, too, because, we saw Coons, that deal happen north of $1 billion. Of course, you saw the Schnitzer deal the year or so before then, which was $1 billion deal, and it got peeled back to around 750 because they had to pull some stores out of the mix. But it's interesting, as we see consolidation continue to move forward, it seems like there's a tipping point where obviously the bigger you get, the fewer the number of potential buyers or options. Wouldn't you say that's true? Because you've got some groups out there that, they're getting very significant in size, and they're on the private side. And if the concept, if the goal is just to continue to become a very big, larger, super successful organization, I get it. But if the thought process is maybe has anything in mind having to do with an acquisition, boy, once you get up to a value of $1 billion, $1.5 billion, $2 billion, $3 billion, who's buying that?
It's a good question. Certainly, if I have a Toyota store that is owned by a person, that's all the stores they have. That person has got thousands of people they could sell their store to. That's really when we have a lot of fun, if we're able to market a single point, because there's lots of people we can go to if the dealer wants us to do that. If I had a $10 billion market cap company, it's a short list. But I would say that what's fun about this business is I know a number of people that own very large dealership groups, and it's fun for them. They like going to work. They like investing in their buildings. They like, enriching their employees. It's really all that they've done and all that they ever want to do. And so for those people, I say God bless, and let us sell you some dealerships so you can get bigger if that's what you want. These new sources of capital are, the amount of wealth in the world today, David, is just astounding. And, there are several dealership groups that are backed by families that are billionaires, and now the operators are becoming billionaires. So some of these guys can take down some of the very largest dealership groups that you can imagine with the help of private capital. I'm not talking about going public, because I think the bloom is off the rose in terms of being a publicly traded dealership group. It's really tough to deal with all the activist investors and all the lawsuits and all that.
Sarbanes-Oxley and all of it.
Yeah,
But
if you ask, Rick Hendrick, would you want to go public or keep private? I'm pretty sure I know what the answer is.
I mean, look at Terry Taylor with AMSI, and I mean, there's many of them, like that, and they're incredibly impressive, each of them in their own right. Speaking of that, there's some really impressive groups out there. That obviously Rick Ford sold his group to Sonic. And they were backed, but you've got some. It's interesting. You have some great legacy family dealership groups that have combined with the backing of very big money, and the combination of those two has to be very attractive to everybody. It's got to be attractive to OEMs, I would think, because I still get to deal with, and I know I've got that legacy dealer in there, but to those very, very wealthy organizations, family funds, private equity, the cash that gets thrown off of our business when it's well run is incredibly attractive. And, being that we're going in a direction to where interest rates are coming down, it's likely that more of that cash is going to want to find a different way to go than it has gone in the last 2 years. That would lead you to believe that we will continue to have organizations like, for example, like Open Road Capital, has a great partner with Bain, and they keep growing these bigger and bigger, whether it's a recapitalization or dealers, as you said, want to take money off the table, or they just acquired on their own. They've always partnered with dealers. They actually acquired that Buyer Auto Group, as you know. So I think it's really interesting. Of course, you got Franchise Auto Equity Partners out there with Don Reese, who's a really good guy, but the business just seems to get more and more interesting, and it's almost like regardless of what happens externally, there is people inside this industry, and the industry is so strong in and of itself. It just seems to find a different way. It's not a matter. I always say I don't believe in good or bad. I believe in good or different. And this industry seems to have bought in years ago to that. It's not ever good or bad. It's good or different, right? Whether it was Ford's plan years ago, decades ago, where there was a belief, I think it was Edsel Ford predicted by a certain period of time that most dealers were going to be owned by publics or by the OEMs. That didn't happen, and we've seen time and time again in this industry where this was going to take us down, Uber was going to take us down, we're still standing.
Yeah.
Right?
No, I think these new sources of capital, they're certainly terrific for our clients. If I look at 2024, we represented Mike Byer in the sale of his group to Open Road Capital, which is private equity firm backed by Bain Capital, which is one of the most impressive private equity
What
firms.
A combination between Open Road and Bain, for example.
Yeah.
Wow.
Yeah. And we represented the owner of Toyota North Charlotte. Excellent store, was purchased by the Hudson Automotive Group, backed by family office.
David Hudson, another one.
Yep. And we represented the owners of South and Hollywood Kia, sold their businesses to Morgan Automotive, that also has a family office backer.
DG. Yeah. Maury's.
A big part of our practice last year was selling businesses to dealers who have a financial backer. So for sellers, I think it's terrific. If you're a dealership buyer in the state of Florida, you're probably a little bit frustrated because it's hard to find something that you can buy that hasn't been snapped up by somebody that has really, really big checkbook. So it swings both ways. If you want to grow, now you're competing with people that are billionaires, that are investing in our business. And so you got to try to find assets that won't attract the billionaires. And that often means smaller assets, maybe turnaround opportunities, et cetera. Maybe some of these out of favor franchises. Because the bigger the groups are, what we see is they typically focus on just big stores. Mm-hmm. To buy a Chevy store that makes $500,000 a year, it's literally not worth the time of these large consolidators.
Yeah, but which creates these opportunities. And one thing I'm seeing more and more, and then I want to get your thoughts as we wrap up about NADA. But Alan, one thing I do see more and more, somebody goes out and buys a franchise that some may consider out of favor, or a dealership that some may say, a big consolidator may say, just doesn't have enough potential net for me to make it worth my while. But somebody else comes in and kind of like the Taylor organization, they say, all right, I'm going to take that Mitsubishi store, that VW store, that Stellantis store, that Nissan store, and I'm going to turn it into a used car beast. I'm going to turn it into an absolute monster when it comes to used cars. And they do it very successfully. I mean, it's really remarkable, some of the stories that are out there now, where I never get tired of hearing about Patrick Abad and his story up at Beaver Toyota, Cumming, Georgia, 7,700 population. And the guy's, he's acquiring 150 used cars a month. He's got 450 used cars in stock. He's got 9 or 10 Toyota stores around him, AutoNation, Sonic, and CarMax, and he's cleaning their clock. You got Casa down in New Mexico, Texas, which is one of the few groups that actually tracks their market share against Carvana and CarMax, and they're winning. You got Rob Ruth, that has a population of 2,200 people selling 40 new Fords and 300 to 350 used cars. And you're seeing more and more, it's almost like, okay, here's another wave that's coming in the business, that people can take these franchises and reinvent them into still being net profit powerhouses.
Yeah, I think that the current conditions that are rough today for Stellantis dealers and Nissan dealers, and I believe they'll get better, but it's going to be a year or two before the tide really turns for them. But those who don't have the patience to go through the turnaround phase, they can sell those stores, and they may go to somebody who's an independent dealer or has a smaller franchise outside of town, and will be thrilled to have the opportunity to represent a major OEM, and they will make it through used cars. They're not going to be trying to sell, 50 new a month, which is what the store used to do. Now they'd be happy to sell 20 new, but 50 used or 150 used. So that's part of the regenerative part of this business.
It's really cool.
Yeah. So I think it's going to be a good year overall for the industry, challenging year for the owners of some of these brands that just dug themselves in a tough hole.
And I think a challenging year for anybody who is not rethinking or reinventing, anybody who's continuing to spend a disproportionate amount of time and focus, energy, and resources on new cars. I think it's going to get harder and harder for them to experience a positive ROI, because in my mind, it is pre-owned cars, it is fixed ops, it is F&I that all create sustainably successful organizations. New cars, you're going to go to a certain degree as the OEM goes. And here's my challenge with it. I actually made a statement that I know some OEMs don't like. And my statement is that new cars will never be the same. I'm not saying it won't be viable. I'm not saying it can't be profitable at some point. What I am saying is it's like an elite athlete that blows out its Achilles. And, being that it was a great elite athlete, they could put in the work. It's going to take a while, like you said, year, 2 years. They come back and they're still much better than the average athlete. Will they ever be the same as they were? No. And I say that because, when we sit here and we've got a median household income of $80,000 in 2019 and $81,000 in 2023, and the price of vehicles went up 35 to 50%. We got general inflation up well over 30%. It seems to me the only way we get back to the volume we had before is either OEMs are going to sit there and go, oh man, we went too far. Stellantis, we shouldn't have raised our prices 52%. I tell you what, we're going to roll them back like Walmart. That's not going to happen. Or is the median household income going to all of a sudden go up from 80,000, 81,000 to 100, 120,000? That's not going to happen. Meanwhile, used cars are continuing to come down in price and stabilize at 24, 25 grand. So new cars, I think it's going to be interesting, and I think dealers have to become more well-rounded. But I fully expect that the dealers that are dominant, that are successful, that they're just going to always find a way to be that way. And we're going to continue, I think, to thankfully see the next generation, men and women, come in and teach them some things and teach us ways of looking at things that maybe we didn't before. So my last question, I'm curious, 2025, I always like seeing you during the NADA convention. And, I did find that there's a lot of dealers that are telling me they're not going. I understand New Orleans maybe to some. New Orleans is in Vegas. Dealers in the west half of the U.S., maybe it's not as easy to get out there. Certainly there's some stores that are challenged this year, maybe thinking differently than they did last year. But I really believe that we're going to see some great innovation, education, obviously great opportunities to get together with people. We'll continue to see new products and new buzz about things. For you personally and for your team at Haig, what is it you're looking forward to as you head to New Orleans for the 2025 show?
Well, we look forward to it for a lot of reasons. First, we host this
Auto Team America.
Yeah, we help to organize this conference. Auto Team America is an organization of CPA firms and other firms like ours. And for, I don't even know now, 12, 15 years, I've been helping with that. And about half the conference is about M&A, and about half the conference is on how to be a better dealer or certain trends to make you aware of. And so I'll be doing an M&A presentation talking about how dealerships are valued today. I'll have the pleasure of interviewing Daryl Kenningham from Group One up there. We have a lot of really impressive dealers that are coming to speak at the event. And in my opinion, it's really one of the reasons why some people come to NADA. That's what we're told, at least.
It's one of my favorite events every year, Alan. I say that without hesitation. It is extraordinary.
Well, we appreciate that. And then we're fortunate to be speaking at a NADA workshop on how to build a dealership group through acquisitions. What kind of strategies and tactics should you be pursuing? We have a reception to invite our friends and former clients and potential clients on Thursday evening. And then, I don't even know, so many meetings where we're going to be talking with clients, trying to put together transactions with buyers. And then just all the relationships that you built up. David, you mentioned you've been in the business for how many years did you say?
45.
45. I mean, if you made, 2 relationships a year, which I know you made a lot more than that's 90 people you're going to try to run into while you're out there. So that's a lot of fun. And I think that, whether it's the OEM that are having a reception or whether it's a bank that's having a reception, whether it's a state dealer association having receptions, just the breadth of our industry is a lot of fun for us. And most of the people that are working in auto retail, they generally care about the business they're in. They're fully invested in it. And it's the personalities, not just, spreadsheets and websites and that kind of stuff that make it go. So for us, it's a really important way for us to renew, and enrich existing relationships, but also meet a lot of new people. So we love going. I think typically the turnout for Las Vegas is higher, but I also think the folks that are coming to New Orleans are coming for specific reasons. They're interested in buying a store. They're interested in changing DMS. They're interested in buying a car wash machine. They're interested in finding a new lender. They're interested in visiting, the Cox booth, which has got 30 software products they're selling, or the Reynolds or other leading providers of software in our industry. So for us, it's fun, and we bring almost our entire team. For the junior guys, it's a way for them to appreciate how significant this industry is, and for them to begin relationships that they're going to be serving, throughout the rest of their careers.
Well, I'm looking forward to it. As I have the last few years, I've got the pleasure and honor of interviewing Jay Vijayan, the founder of Techion. On Saturday, I'll be doing some other podcast interviews at that booth. On Sunday morning, I'll have the pleasure of interviewing Alex Vetter, CEO of Cars Commerce, and moderating some panels in their booth. And I've got some other events that I'll be doing there. Of course, you got all the afternoon, evening events. I think there's like 5 Friday that are all within a 5-hour block that I'm just figuring out how to maneuver, which would not even be possible in Vegas because it takes 40 minutes to go half a mile. but in New Orleans, it's doable. I'm excited about seeing you, seeing your team, seeing Auto Team America, what happens at that event. It always seems to be such a bellwether and such a tone setter for not just the convention, but for the entire year. And you guys do a spectacular job of bringing in a great mixture of dealers, thought leaders, on the M&A side, the financial institution side. So it's just such a great way to kick off the event. I'm flying in on the 22nd, so again, I can go there. And just, of course, running into people, as you said, but I really look forward to NADA. For those that aren't going, I certainly respect your decision. For those that are, I have no doubt they are there laser focused, as you said, for a reason. They want to learn, they want to get better, they want to innovate, they want to figure out, how do I go from where I am to where I would like to go? And the one thing that I do know is, as always, it's going to have a lot of energy. I think it's going to have maybe even more optimism, more excitement because of the new administration coming in. And I really look forward to seeing how it all unfolds. But thank you for taking the time to join me. It truly is always a pleasure to see you here. I owe you a drink somewhere in the course of New Orleans. I think the three things you could certainly count on is butter, fried foods, and cocktails in New Orleans. You can count on
I know what kind of cocktail we're having, David.
Vieux Carré, my friend.
And that's the best place to have it, in a French-speaking town.
Well, not only that, you may not know this, the Vieux Carré was actually invented in New Orleans.
Mic drop moment.
Boom.
Can't wait to see you there, David.
All right, you too. Thanks so much for everybody who took the time to join. Thank you. Certainly hope that we delivered big time. I believe that Alan shared a lot of tremendous information. I know that will be incredibly valuable for you. If you want to share this out to anybody who's thinking about selling their store, thinking about the 2025 outlook, please take the time to share it out. You could also find Alan by going to Haig Partners website. You could also download their quarterly report, which is valuable. I get great information from them 4 times a year there. You could go to davidspisak.com and get direct connection to here, to this interview. You could also get it on Apple Podcasts, Spotify, or wherever you get your podcasts. And I'll give you also show notes, as well as different ways that you can connect with Alan. And hey, you may never know, you may find yourself having a Vieux Carré with the one and only Alan Haig. Alan, thanks so much.
All right. See you soon, David. Take care.
See you later.
Thank you.